Okay, before I further introduce the accounting cycle, let me introduce other concepts and terminologies in financial accounting. The general ledger is a collection of accounts. I will show you an example in the general ledger. If you turn to the slide 48, this is part of the general ledger. You can see there are many accounts. You can find cash account, accounts receivable, supply, prepaid rent, inventory, office equipment. These are all assets. Liabilities, accounts payable, deferred rent revenue, notes payable, these are liabilities. And the rest are equity. So I use these lines to separate them. And this is a general ledger. Basically, is a collection of all the accounts that are affected during this accounting cycle. The influence from the transaction were posted to each account. For example, for cash accounts, there are 11 items. That indicates there are 11 transactions that have impact on cash accounts. Where this information from? You may see here a GJ1. This represents the general journal, page 1. You can go back to the journal to find the related transaction. And you also find that each account has such shape with account's title at top. Then just like a letter, capital letter T. Yeah, so this, we called it T accounts. Let's go back. The T accounts are used for instructional purpose instead of formal ledger accounts. Yeah, so here for a T account, at top is the account's title. On the left side is debit side, while the other side is credit side. If a transaction we debit a account, so the information will be posted on the left side. Similarly, for a transaction that we credit a account, we're going to put the information on the right. The purpose of the T account is we will put all the information into this account, either credit or debit. Finally, we will have the balance of these accounts, either debit balance or credit balance. Depends on which is greater. So if the total debit is greater than the credit, the account will have a debit balance. You will see a number appears here. Otherwise, if the credit is greater than the debit, you will see a credit balance on the right side. We find T accounts in the general ledger, right? So the purpose of these T accounts is to post the information from the journal to the T accounts. Finally, we can have the ending balance of each account. Then later, we can prepare the trial balance, which is step 5, following step 4. So the T accounts and the general ledger is to get the balance of each account. So here I mentioned debit and credit. Before you learn accounting, we usually use increase and decrease to describe the change of the account's balance. But in accounting, we use debit and credit. Debit and credit may mean increase or decrease. Depends on the account. Okay? So here, assets, expense, loss, and dividends. These 4 elements or that accounts can be classified into one of them. We call them debit accounts. In other words, if these accounts increase resulting from a transaction, we will debit these accounts. Conversely, liability, paid-in capital, revenue, gains, these are credit accounts. So we will credit to these accounts when they increase. Of course, if they decrease, we will debit these accounts. It's quite annoying in the beginning. It's like you learn a new language. Later on, when you have plenty of practice, you will get used to these new rules and languages. So in the beginning, you should memorize these rules. Just show you one simple example. Yeah, this transaction was borrowed from the prior example. $40,000 was borrowed from bank, and note payable was signed. So this transaction, we know, the company who borrowed money from bank will receive the fund, $40,000. Well, a liability should be recorded. Why? Because a note payable was signed. So this transaction has impact on the firm's financial position, right? Both assets and liability. We know assets increase $40,000, while liability also increased $40,000. Now we do not use increase or decrease. We use debit assets $40,000 and credit $40,000. You know, because cash is an asset account. Debit $40,000 means cash increase. While notes payable is a liability. We know a credit means liability increase. Okay, we are very close to the journal entries, but now we just get used to the meaning of debit and credit to different accounts. You need to visit this PowerPoint a lot of times. Another useful slide help you to memorize these rules is this one. We know asset is a debit account. That means when assets increase, we debit this account. When assets decrease, we credit. While liabilities and equity, they are both credit accounts. We know we learn from this rule, right? Liabilities, equity. When both increase, we credit them. When both decrease, we debit them. Why? Yeah, the reason is because this equation, assets is on the left side of this equation, while both on the right side of this equation. So actually, if you think debit and credit is so confusing, you can just memorize them this way. Debit is left. Credit, sorry for my handwriting because the iPad is not stable. So credit is right. So that means the treatment to the accounts. Yeah, when you debit a account, you basically put the number on the left of the T account. When you credit one account, you basically put the number on the right of the T account. Left and right make more sense. But we're accounting majors, we still use debit and credit. But left and right are easier for the beginners. Then we break down the stockholders' equity into contribute capital as what I introduced, right? This is contribute capital. This is earned capital. Both have direct relationship with the stockholders' equity. So these two are also credit accounts. And that means when the firm contributes more capital, this accounts increase, we should credit. Yeah. So the contribute capital increase, it is equivalent to the increase of stockholders' equity. Also, when earned capital increase, we credit earned capital. It is equivalent to the increase of the stockholders' equity. Next, this is not a breakdown. This just shows the relationship between retained earnings and these three. that have impact on the balance of retained earnings. Yeah, in the accounting treatment, we usually do not use retained earnings as a count in the journal entry or to record transactions. Instead, we use these three. Why? Because we need the first two for income statement, while the next one is for the statement of stockholders' equity. Because paying dividend will reduce the retained earnings, which will reduce the balance of stockholders' equity. They have this mathematical relationship. The revenue has a positive relation with the retained earnings. Okay, so revenue or gains, they both are credit accounts. When the firm recognizes revenue or gains, we will put the number on the right, credit. If the revenue and the gains reduce or we remove this revenue or gains, we will debit these accounts. Conversely, expense and losses are debit accounts, the same as assets accounts. It is debit accounts. When the firm recognizes expense and losses, that means expense and losses increase. We will debit these accounts. When the firm declare or pay dividends, we will debit dividend. The reason these two are debit accounts is because they have negative relationship with the retained earnings, while revenue and gains has positive relation with the retained earnings. Remember, when we prepare income statement, revenue and gains are additions, while expense and losses are subtractions. The negative sign changes the direction of the accounting treatment. And so expense and losses both are deduction from revenue, so they are both debit accounts. Now let's start first two steps of accounting cycle. Okay, the first step, we should identify the external transactions and events that have impact on the accounting equation or the firm's financial position. We should find the documents. The documents may be invoice, bills, and cash register tapes. But these are a source of the information for us to identify whether we should record this transaction or not. The criteria is whether this transaction will change the firm's financial position. We can obtain the information, for example, the date of transaction, the nature of the transaction. Is this a sale, a purchase, the participating parties, and also, very important, the monetary terms or the amount. Don't worry about this step. You will be given the transaction or events description, straightforward, easily understood. Okay? We focus on the second step, analyze the transaction. Basically, we change the description of transaction into typical journal entries. But before we make the journal entry in the step 3, we should analyze the transaction. By processing the documents, find the useful information, and determine what's the dual effect on the accounting equation. In other words, what accounts are affected? Is it increase or decrease? That's the transaction analysis. The journal entry, basically, we just use standardized format. We call it journal entry to record this transaction into the journal. All the transactions, no matter where they are recorded, in what format, finally will be converted into standardized journal entries. That's the purpose of the first 3 steps. Okay, now let's start making journal entries. Now let's start our transaction analysis. So first, an attorney invests $50,000 to open a law office. What's the dual effect, right? First, from the perspective of the law office, its business, and receive money from an owner. So the money is an asset, right? So cash. Also because this is contribution from the owner, equity. Or also, for the contributed capital, we record it in the accounts, additional paid-in capital. We identify two accounts, cash, stockholders' equity, actually should be additional paid-in capital. Because from the perspective of law office, cash increased by $50,000. So we put the number on the left. Well, the owner's claim increase accordingly. Because stockholders' equity is credit accounts, we put the number on the right. This is credit. That's transaction analysis. Next, $40,000 borrowed from bank and a note payable was signed. In this example, we know the company's asset increase $40,000. Yeah, we know the asset is cash. Because it is borrowed from bank, liability increase. The dual effect or double entry system is we identify the two accounts that are affected. We put the assets increase $40,000 here. That's a debit, right? While the liability, the claim of the bank, increased $40,000. We put on the right. This is credit. On the left side, we use accounting equation to identify what's the impact of this transaction on the firm's financial position. The change in the financial position means the change in the accounting equation. And then we identify what accounts are affected, what are the amounts, and then we put the information here. Okay, so you will see the dual effect, right? Two accounts affected, one debit, one credit. Next, supply purchase on account, $3,000. The supply, $3,000. Assets increase. Well, this is purchase on account. There will be a liability to the supplier or the vendor, or the additional liability, $3,000. So assets accounts increase with debit, $3,000. Liability to the vendor increase $3,000 with credit. Two accounts, debit and credit. Number 4, service performed on account for $10,000. Because service performed according to the revenue recognition principle, revenue should be recognized. So stockholders' equity increased $10,000. While this is a performed on account, the customer deferred the payment. Instead, the company, the law office will recognize $10,000 accounts receivable instead. Here, the $10,000 increase is in accounts receivable accounts. Accounts receivable is an asset, it increases, so we debit this account. The revenue accounts, we will credit revenue accounts $10,000 because it is credit accounts. Again, two accounts, debit and credit. Next, salary $5,000 was paid to employees. Because this is a payment, right? It indicates a cash outflow. So assets decrease $5,000. And the expense should be recognized. So expense is a debit account. It reduces stockholders' equity. So we will debit expense accounts or debit stockholders' equity and credit assets, cash. Okay, so this is our first time to credit an assets account. That means this assets decrease. When we debit expense, that means expense is recognized at the increase from 0 to 5,000. And the impact is it reduces stockholders' equity. When we debit expense, it is equivalent to the debit of stockholders' equity. Again, two accounts, one debit, one credit. Next, $500 utility were incurred but not paid. So utility is an expense to be recognized, right? So we're going to observe a decrease in the stockholders' equity because an additional expense. Yeah, expense increase, so we debit expense. It's similar to the debit stockholders' equity. This is a pending payment, so we will recognize a liability. This is a liability to the utility company. Yeah, liability increase, accounts payable, we credit liability. So in this transaction, we recognize the expense and a liability. Two accounts, one debit and one credit. Last one, $1,000 was paid on account to the supplier's vendors. So this transaction is associated with number 3. Remember here, the supplier, the vendor supply $3,000 on account, right? So there was a $3,000 liability to the vendor. In the transaction 7, the law office now pay $1,000 to the vendor. So that means the liability, accounts payable, is partially paid off, right? The company make payments, the assets reduce, while the liability is paid off, so $1,000 decrease. This, look at the accounting equation, right? It's still balanced, both sides decreased by $1,000. And the cash, we credit cash $1,000 because it reduced. While the liability reduced, we debit liability. See, 2 accounts, 1 debit, 1 credit. That's all the examples. So that's also the transaction analysis. Okay, so when you read the transaction, which are described in plain English, it includes the information regarding who are involved, what's the amount. And by reading this sentence, you know what type of transaction it is, what's the impact of this transaction on the firm's financial position. In this chapter, you're going to have lots of examples and also homework regarding this. This is the first 2 steps. In this class, you will be given not documents, okay, but just the description of transactions. The next, you analyze the transaction by identifying the 2 accounts, at least 2 accounts. You should analyze the transaction and find out what's the impact of the transaction or events on the firm's financial position or the accounting equation. Then, which 2 accounts affected? Maybe 3, mostly 2 accounts. Increase or decrease, and what is the amount? So that's the first 2 steps. So in this section, I also introduce debit and credit. Debit and credit, they are not equivalent to increase and decrease because depends on what accounts they apply. So you should memorize these rules.